Good morning, everybody. It is Friday, August 2nd, 2019. We've jumped 3 years since last week when I announced that we were in 2016. I got that mentioned on the YouTube channel. So it is actually 2019, August 2nd, the week of another round of trade tweets. And you can see that the stock markets are extending their losses right now. And the no deal, fake deal scenario is shaking out with regard to China, and I think heading more and more towards a no deal. Back in April, when we talked about China trade, I suggested, and I think I actually first mentioned it in February, that it seemed to me that the Chinese were stretching out the trade negotiations. And a year ago almost, all the way through last December, the agriculture that they had bought and the other things that they had done put them into a position to wait out the presidential election in the United States. And I thought that meant the Chinese really didn't have much interest in cutting any type of a deal beyond buying a little bit more stuff from us, because structurally they're not going to change, particularly since there is no alliance pushing up against them. You know, at this point, it's the United States against China on the trade war rather than the entire West and India and Japan and South Korea standing up to China. So from a standpoint of tactical awareness and just strategy, the trade approach that the Trump administration has taken is failing. It is failing miserably, and it was probably a bad idea to begin with, like I suggested a year and a half ago. You cannot stand up to a superpower like China one-on-one. We need to put together our allies, go to China and say, hey, we can't do business with you unless you make these changes. And that would have been a way to stand up to China. So I'm in favor of standing up to China, but we can't do it alone, and this is proof. China is just going to wait out the election. There's not going to be any significant trade deal. Sure, at some point, they might get agriculture and liquefied natural gas and a couple other things so cheap from us that they take a deal. But unless they get what they want, they won't cut a deal, and they for sure will not cut a deal that changes how they do business and how they view their approach and how they view their plan. They are playing the long game, and this trade war is going to get worse. It is an underlying principle of my Crash 2020 thesis, where I believe the second half of next year could be absolutely miserable, look a lot like 2018, or maybe worse. So what do we do about it now? Well, on Monday, we bought, folks who are doing these types of trades, bought VIX calls. And the week before that, we bought some SPY puts at 295. 295 is a support level that if we finish below 295 today, we probably have a lot more downside. So let's take a look at some key indicators here. And what you'll see is on the daily charts, the money flow has turned over dramatically right there. Money flow is falling down badly. We are probably going to break through this 292 level on SPY, end up somewhere in this range, low 280s, maybe upper 270s, but right in there. And there is the possibility, of course, that we get another December annihilation. Now, I don't think that will happen because the offset is the end of quantitative tightening, which I've been talking about all summer, and that is $50 billion a month that will no longer be coming out of the financial and economic system. So I don't believe we're going to get a repeat of December, because all of the factors that lined up for the December crash have not lined up. Hedge funds are not liquidating. We do not see tax loss selling because it's an up year. So something along this line, getting back down to support on the 200-day moving average, seems to be about right. So where does that put us on QQQ, which is what we're way more interested in investing when we get a chance? So I have my limit orders on QQQ at 175 for my first batch, right? If we break through the 200-day moving average and it looks like we're going to see this, then we don't start buying a second batch until we're in the 150s. So while I don't think this is probable, it's not impossible. This is probable. So I buy my first scale in around 175 on QQQ, as we talked about in the article that I did a couple of weeks ago, titled ETFs. We're putting up so much content now. ETFs I plan to buy soon. So keep an eye on these. QQQ around 175. It seems more and more likely that we get there. Now, could we bounce off the 50-day moving average? Absolutely. I don't know that would be super healthy, but I'm gonna go out on a limb here and say that we probably get down to the 175 region. So how are we managing our hedges? So most of you should have doubled your money on the VIX in the last 4 days. So if you have doubled your money in 4 days on a 2-3-4% position in your portfolio, that means that you have basically done a mirror image of what the stock market has done. So what the stock market went down, you went up. And that probably is pretty good for you, right? But I introduced the concept that I'm calling the Greedometer. And I am going to probably write an article about the Greedometer, because I think that managing our greed and our fear still is the most important thing we can do as investors. I originally had set my limit orders to sell 2/3 of my VIX position once it doubled. We're there. I have pushed my VIX levels out to a triple. So if it expands a little bit more and I triple my investment on VIX, that's when I would sell 2/3 of the position. Now, what does that say about me? That says that I'm being greedy right now. Why am I being greedy right now? Because I really don't see VIX not jumping quite a bit here in the next couple of weeks. So if we pull this out, we can see that getting all the way up to low 30s seems pretty probable at this point, given what's going on in the markets. We got a Federal Reserve that lowered the rates by a 1/4 point, but said, hey, this doesn't really mean that we're going to lower rates a lot. President Trump stinging from the Chinese kicking us out of China after 4 hours of negotiations because President Xi was insulted by one of the tweets. Retweeted after the Fed the very next day, hey, we're going to put sanctions, not sanctions, but more, somebody's making noise. We're going to put tariffs on 10% more of the goods from China. So let's explain these tariffs a little bit. I'm not sure if anybody thinks on this call, or people who may watch the YouTube later, that Americans, or that the Chinese, that the Chinese are paying the tariffs. That is not how tariffs work. Our importers pay the tariffs, and then they pass the costs on to consumers. So this idea that we are forcing the Chinese to pay us tariffs is a lie. It's not even a half-truth. It's just a flat-out lie to people who don't understand what tariffs are. And most of the people who hear it and believe it, they'll never Google what a tariff really is. So don't fall into the trap that somehow we are punishing China more than we're punishing ourselves. What is likely to happen here, in my opinion, is that things get worse before they get better. But then quantitative tightening offsets things within a month or two. The ending of quantitative tightening, that is. Again, we've been talking about that for months. If you're trading this, check your Greedometer and decide at what point have you created enough space between you and the down market. Remember, we came into this 35 to 65% in cash. So our asset allocation as of a month ago was to accumulate a ton of cash. So if you're a retiree and you're following me, you should have been way heavy in cash. And even if you're aggressive, I bumped up your cash allocation like 2 weeks ago. So hopefully you actually were paying attention. Man, these guys are... So Dave and Dividend Sleuth apparently have some time on their hands because they've been posting like every week a couple times. So this is what we talked about on July 24th. The VIX is extremely low. This signals a tide change is coming. We're having a tide change right now. We got this to within a week. The Fed rumor is being bought. The news will likely be sold. That's what happened. A conflict with Iran is becoming more likely. Let me show you something. If I can find it again. Iran owns the Persian Gulf now. If that's the news, what do you think President Trump's going to do about it to assert himself? Do you think it'll just be a tweet? Or do you think maybe he doesn't call off the next bombing or missile attack? There is 3 million barrels of spare capacity with Saudi Arabia right now because Saudi Arabia has cut production that much. What I want to show you here is a headline from oil price. Some of these are in alphabetical order, some of them aren't. Well, oil price was talking about, if you go on to oilprice.com, you can see that, man, am I blind? Well, I subscribe, so. They have an article about spare capacity. And I think that's the most important article that's on here right now. OPEC oil production dropped to an 8-year low. That's why oil's going up today. The Permian oil boom is on its last leg. I don't know if that's quite true, but like I told you a while back, oil is going to flatten out. Our production is going to flatten out. And if we can ever find it, there's an article in here about spare capacity. So if you go to oilprice.com, take a look at that. Let's move back to our strategies here. We had moved into a much heavier cash position. We bought some fixed calls and some SPY puts. On your Greedometer, you've probably doubled your money on those SPY puts. As you can see, I'm up a little bit today on the swing trading portfolio. and about even on the other one. So it looks like this market must be coming back just a little bit, huh? A little bit, not much. The SPY puts, I bought at 573. They were a little over 10 a couple minutes ago. I have my sell order at 12, but I will probably change that to about 15. So from 295 down to 280-ish is 15, plus a little time value. I'm cool with 15. So this is, again, these 200-day moving averages, I think, are probably going to hold. Without the end of QT, I don't think that they would have. But I think the end of QT means that the 200-day moving averages hold, especially in light of hedge funds aren't selling, tax loss selling is not going on, and the economy is not bad. I mean, it's flattening out in like every respect, but it's not bad. So if there's an oil price shock, which is where I was going earlier, that's what would cause inflation. Somebody asked about the tariffs. Will they increase inflation? A little bit. But I don't trust our inflation numbers. I haven't for probably 15 years, 20 years. So you have to figure out how individually how that feels to you. If you're buying electronics, most electronics are going to go up between 5 and 10%. How does that impact Apple? How does that impact semiconductors? Those sorts of things. If we see a price shock in Iran, then all those oil positions that we're underwater on suddenly move towards even and maybe even profitable. Why? Because, what is it, 16, 17, 18, whatever it is, there's a lot of oil that goes through the Straits of Hormuz. If that gets disrupted for 1 month, all of the spare oil in the world is basically going to get used up. So we'd be way below on inventory. And do you believe that the Saudi Arabians would ramp up production right away? I don't. They need the money. So I think that there would be some heels dragging in the sand, and I don't think you'd see oil production, that 3 million barrels a day of extra productive capacity. I don't think you'd see that get utilized quickly. Would they throw 1 million barrels on the market within a month? Yes. How long would it take them to throw 3 million barrels on the market? As long as they want. So if they can get $80, $90, $100 a barrel, which is where oil would go to if the straits closed, they will keep it there. They will manage the price of oil to keep it in that $80, $90, $100 range as long as they can. And they probably won't chase the price of oil down until they got what they wanted. So we have to consider everybody else's interests. The reason the trade war isn't working is because we underestimated China's interests and we didn't line up enough people against them. The reason why oil price spike would last longer is because Saudi Arabia has taken it on the chin for years now, and they need to make some money to transition to another type of an economy. Technology is coming so fast on alternative energy that they can't push it out. They can't make their money in 5 years or 10 years. It might not be there to be made. So if President Trump attacks Iran, expect a few things. Price of oil goes to $80, $90, $100 a barrel quickly. That will be what pushes inflation numbers up. At that point, the Fed is in a bind. If we start to get resource-driven inflation and the economy starts to slow down because of the trade, where does that leave us? What I'm taking you to is a scenario that by the second half of next year is not very pretty. We could see higher inflation from oil prices, so that hits pocketbooks. That is a drag on the economy. the trade tariff war is not going to magically disappear. Japan is fighting with South Korea. We have an announcement coming in a couple hours that I'm not so sure with regard to the EU that's going to be good. I'm very afraid that President Trump puts pressure on the EU in about 2 hours. If he does, that's really bad. Hopefully, he backs off on the EU. He says, hey, we got some good deals, and things are going to be great. I hope that's what he says. I hope he doesn't raise tariffs on them. I hope he doesn't put tariffs on their cars, because you would just see the global supply chain for car parts fall apart, and that is one of the biggest employers in the world. So 2 hours from now, we'll see if the VIX picks up. I am willing, with my Greedometer, to speculate that VIX goes up substantially in the next week, and that the S&P 500 drops another 5, 6, 7, 8%, QQQ along with it. If all that happens, then what? Well, then we have to take into account the end of quantitative tightening, and then do we believe that that is going to be that powerful? Well, Stanley Druckenmiller and I posted this. I wanted you to watch it. If I post a video, it's serious. I don't post a lot of them. But I put Druckenmiller's New York Fed, or New York Economics Club interview up here. If you're on YouTube, Google Druckenmiller. Here we go. That's not the one. Got a late start today. I had a spare dog. Sorry this isn't laid down as easily as it normally is. Oh, good grief. There we go. Oh, this one. Stanley Druckenmiller talks about how the market started to roll over once we started doing the $50 billion a month in quantitative tightening. And if you go back, I've been talking about that for a very long time. So by peeling off that $50 billion a month of quantitative tightening, I think that that's enough to keep us from really crashing through the floor for now. But ultimately, if we start getting slowing GDP numbers early next year, and if unemployment starts to go up, remember what I told you about unemployment. If unemployment ticks up, people have to start spending their retirement plan money, right? So about 1/3 to 40% of people who lose their jobs in a recession, or at least for a long period of time, longer than, 6 months or 8 months or 9 months, they typically tap into their 401k. That ends up being forced liquidation. In a world where we're basically trading ETFs, we buy stocks, but a lot of people are just ETFs and funds. That ends up being a lot of forced selling in the S&P 500. So we have to really keep an eye on unemployment. Unemployment goes up, that is horribly bad for the stock market. Right now, we have a lot of people contributing to 401k plans. But again, if unemployment goes up, that is incredibly bad. So we want to keep an eye on that. If you take a look at some of the trackers out there for unemployment, what you're seeing is that it might already be started and happening. Citigroup is getting rid of a bunch of traders. Car companies are doing layoffs and closing plants, which is big business. That's big business cars. You remember the saying, as GM goes, so goes the rest of the economy. Keep that in mind. I don't know if it's just GM, but the car industry in general, if the car industry in general tips over, that's really bad for the economy and for the stock market. So anyway, let's take some questions. I'm going to put out a lot of writing over the weekend. I'm taking Sunday to write a couple of articles, including stocks that I want. But in general, We want exclusively stocks on our short lists. So if you're a retiree and you want low volatility, high dividend, we have stocks for you. If you're a dividend growth investor and you can take a little bit more volatility, we have stocks for you. And if you're a younger growth investor, pure growth, we have stocks for you. Over the next month, I will finish up the growth list. I've been saying that for a few months, but I'm real close right now, so I'll probably be doing some updates. Dimitri, if you're listening, yes, go ahead and apply those changes to the spreadsheet. I do have an IE Cloud key to update the dividends, so I'll email you that, and then we can go from there. But yes, I am going to be talking about stocks I like. Newmont Gold Corp is pulling back. I like that. Kellogg is interesting, right? So this is getting put onto the retirement low volatility list. Nutrien, again, if you're a dividend investor of any color, you want Nutrien because the changes in the climate are probably going to force us to use a lot more fertilizer in the future, as well as we're going to have to start doing more greenhouse growing, but that'll be slow to come. Somebody's asking about a hard Brexit. I don't know. It doesn't make sense that they would do a hard Brexit, but that doesn't mean that they won't. There's a lot of things in the world right now that are bad ideas, that are driven by nationalism, that is driven by xenophobia. And the ideas that closing your doors, that not having trade deals, these ideas don't work. And I understand the emotional draw to them. That's why we got Hitler. But the idea that we are going to tariff or kill trade deals, which is what a hard Brexit is, and close our immigration doors, if that's going to somehow help us, get real. It's never worked ever before. It won't happen. It won't help this time, especially in an age. And again, I know a lot of people don't want to acknowledge this, but we have major climate change pressure on immigration. There are people that have to leave India. Are we going to tell them no? Seriously. Their drought there is so bad, and the heat is so bad in India that it's becoming unlivable. They have to go somewhere. People will migrate. So, again, that's why I say things like I did a few weeks ago that, I don't think I would want to live in the desert Southwest. I mean, I think Las Vegas might be an exception, but I think places like Albuquerque and Phoenix and other desert Southwestern cities, they're in big trouble because the water situation is just going to keep getting worse. The debt in the state of Arizona is up 50% in 4 years. It's not just immigration. It's not immigration driving that. It's stupid tax policies, stupid regulations. And they're not even funding their schools. So you better consider where you're going to live in the next 10, 20 years. Because you better go somewhere where there's water, and you better go before it's too late to get there. And that's why I'm extremely bullish on Great Lakes real estate. If you are in any of the Great Lakes basins, you're in a much better place than most other people. And you can say, yeah, well, with the weather, it gets cold, you get winter. Yeah, we get winter. Not as much as usual as it was used to. We had a harsh winter this year, but we had 4 or 5 that were pretty mild. So we need to think about the interrelationships that are going on here, from monetary creation to debt piling up to demographics driving deflation, to technology putting people out of work, to trade wars that respond to yesterday's problems but don't really apply to the future, but we're doing it anyway. To climate change driving migration. There's a lot of problems coming, and I believe that everything's fixable, and I'm a long-term optimist. But I'll tell you what, next year, year after, man, doesn't look good. So what am I going to do when, Boris Johnson does a hard Brexit? Right before, so I put off doing this VIX trade until the last minute. And that's the way you should do a VIX trade, because it either goes your way quickly or it doesn't go your way. We'll keep an eye on Brexit. And if it looks like they're not going to have a deal or an extension, we'll buy VIX again in a month or 2 months. Because I expect to be out of these VIX trades next week. So, there's that. We bought a little teeny tiny stock called Marin Software a while back. And we just took little itty bitty starter positions. It's down 50%. I think this might be an opportunity to add a little bit to your position. Read their report on digital advertising. We're going to get news from them about their sales real soon. I suspect that their sales are growing even faster than we had hoped. And I think that would be good for us. This is a very thinly traded stock. You can only buy a few shares at a time. So if you want to accumulate, you have to do it over a period of time, and you're going to probably bid yourself up. I have a 1% position in this company in accounts that will take this type of a stock, right? Because it's a super high risk stock. But if this is a trough to buy this in, and QT drives a bit of a rebound in say the fourth quarter, we could get a pop on this. Then we even out our position as people become more interested in it. But even though the market's going to do bad, there are always going to be companies that are generating enough revenue in a changing world to make them worth our while. One of the reports I'll be writing, actually there's going to be multiple reports, but it's going to have to do with investing in the 2020s. So we're going to have a dividend investing in the 2020s report, growth investing in the 2020s report, and how to retire comfortably and with some stability in the 2020s report, because I think that the projections by people like Jeremy Grantham and Morgan Stanley and Goldman Sachs, I think they're probably right. I think the growth in the 2020s is lower because we're going to fight about whether or not to do something like the Green New Deal. We should do a Green New Deal, but without borrowing money. So that's my answer. We don't have to borrow a ton of money to do the Green New Deal. We just have to change regulations and taxation policy. Almost everything can be done by changes to regulation and taxation. We don't need to just borrow a boatload of money. But we'll fight about it, and we won't do it quickly. We'll do it slowly. We'll do it in bits and pieces. We'll have to pick our spots on where we invest. But this is one of those spots that are growing. So if you take a look at the ETF article again, you have this chart from ARK Investments. This is where growth is going to be. These are the places where the economy is going to grow in the next 10 years. This is where we want to be. We don't want to be in these REITs that somebody said today have a moat. I took a look at that article, and you guys will know who it is if you follow the REITs. We've done a lot of work on REITs here. Dividend Sleuth has been working on it. And one of the REITs that was talked about as having a moat was Simon Property. I am intimately aware of how Simon Property works. I specifically travel around the country and look at their properties, take pictures, and I have pictures of abandoned malls all over the country. I'm telling you, Simon Property does not have a freaking moat. There's no protection to them. So they have millions and millions of dollars, tens of millions, hundreds of millions of dollars of renovations they have to do. What happens if money becomes tighter? Right? So piling on debt to survive is a bad strategy. And unless there's a major pullback in real estate, I don't want something like that. I mean, I'll buy real estate because there's only so much of it made, but not when it's expensive. And real estate's freaking expensive right now. It's not 2007 stupid expensive, but it's 2005 where's the last sucker expensive, right? So if you're buying real estate right now, you're probably a sucker. So, keep that in mind. Don't do it. Unless you find a gem of a deal, be careful with real estate. And, if you're looking for a house, buy the crappy one in the good neighborhood and suck it up and remodel yourself. Don't buy the curb appeal house that's going for over asking in a bidding war, because you're going to take it in the shorts. You might even end up underwater for an extended period of time. And what happens if somebody in the household loses a job? All these things happened in 2007, 8, 9, 10, 11, 12. They can happen again. I don't think we're on the verge of a financial crisis, but I think we're on the verge of a very wavy, bifurcated decade where growth is rewarded and value isn't really value, it's really a value trap, because in industries where there's no growth and there's only financial engineering to keep you going sideways, eventually that falls off the cliff. 2020, 2029, I don't know. But stay away from those risks. At the micro level, with you buying a house, if you're buying a building like I'm looking to do, if you're making investments in REITs, I'm telling you, the REITs are going to drop 20 to 30%. So do you ride it out during that period of time? That's not a bad strategy. Just understand it's going to happen. I would be buying REITs right now. If I already have them, I'd be trimming them. And I'd be figuring out a different way to generate income. And as far as income goes, if your money is mainly in retirement plans, what do you care if you make your money on dividends or capital gains? Comes out as income. All you care about is total return. So protect your assets, right? I'm going to write a pretty scathing article about REITs. So if I can get it out this weekend, I will. Because that article today about REITs that have moats just kind of blew my mind. There's a couple that do. So like some of the REITs that house server facilities, those are hard to replace because those buildings have to be super cooled. And by the way, anybody notice that First Solar, somebody posted in our chat board, First Solar is putting solar on top of the Microsoft buildings that have all their servers in it and all their cloud servers. Why? Well, one, if you put solar on top of the building, you're helping keep the building cool, and that's what a lot of that energy goes for, is keeping those buildings cool. And then you're providing the energy to boot. So think this through about how we're going to invest in the 2020s. This year and next year is positioning. It's protecting ourselves. It's transitioning our portfolios away from the old economy, which, we took a first step by cutting back on our oil investments. I have no idea why oil is up 3% today. but then the oil stocks are still down. You know, I explained this to a client this week, actually 2 clients. There is a disconnect between value and what a stock is priced at. Druckenmiller in that interview talks about how the super low interest rate gets rid of the hurdle. So there's no free interest rate that you're trying to get over. Now, it used to be, hey, I'm not going to buy a stock if I can't at least beat the 10-year treasury. 10-year treasury is at 2%, give or take. There is no hurdle anymore. And people are all, and especially the millennials, are all piling into tech, anything tech related, anything on this chart. So there are times when necessarily we have to buy something that is already fairly valued. Why? Because we know that the hedge funds and the millennials and the algorithms are going to bid it up. The same way that they bid down the oil stocks. A lot of companies that are extremely profitable, their stock price does nothing but go down. Why? Because it's not favored by the hedge funds, the algorithms, and the millennials. And the millennials are becoming a bigger and bigger part of the market. Ultimately, I expect a major wave of mergers and acquisitions in the oil space. And if there's no oil supply disruption and these oil stocks don't recover, then we're going to see a lot of take privates. And if you can find any way to go work for an oil company that's going private, do it. Because they're going to basically keep all those profits in-house, not share them with shareholders, and it's all going to go to the people who work for those companies, particularly the executives and managers. So that's, there's not going to be any bankruptcies in the oil space, not the companies we're in. There will be bankruptcies in the oil space. The little companies, the companies with crappy balance sheets, companies we're in, I don't worry about it because at worst they get taken private by the executives. We get a little bit of money back and we scratch our head and go, man, we get screwed twice. But, profitable companies don't necessarily get bid up by the stock market because people are emotional, people are in their own little worlds, and people are chasers. So when somebody says, hey, is this going to go up? I say, well, maybe. Some of the stuff out there is worth a lot more than what it trades for. There's this concept that, hey, if I had to go out and just write a check to buy the company, what would I pay? Most oil companies' stocks are way below that price. Most tech company stocks are above or way above that price. There's not a lot of rational behavior in the stock market when interest rates are low. So we should keep that in mind. And if we get this pullback to these levels, right, that's probably where we start sniffing around. Somebody asked about the ARK fund. Same thing, right around the 200-day moving average. 44-ish. Could it go all the way down here? Remember, the ARK fund is heavy in Tesla. So you don't really, if you own this fund, you really don't need to own your own Tesla shares. So if Tesla takes a digger, then this fund takes a digger. So low 40s. So maybe goes through that a little bit, low 40s right in there. Remember, this is a managed fund. It's concentrated. It should not be a huge part of your portfolio. Single digit or very low double digit. All right. Yeah, SunPower. SunPower's been good for us, hasn't it? I do get ripped on because I've missed on the oil stocks the last year. But there's certain stocks that we've done okay on, right? We were buying this one $6-7 a share about a year ago. It's doubled in a year. I can live with that. Something not as sexy. Nutrients up a couple bucks, right? We've bought it on all the dips for the last a few years. Ever since I owned potash before I owned this. You know, it's kind of drifting up. But if you're a dividend investor, that was a pretty stable chart, isn't it? And it's kicking out over 3%, and the dividend's going up, and they're buying back shares, and there's no more supply of fertilizer coming on for 3 or 4 years, and demand is going up. This is a low volatility. This is a low volatility stock. 44 at the bottom, 57 at the top. I mean, that's a pretty narrow range. I mean, the chart looks like that because it's a short chart. This used to be Potash Corp, and it's just been drifting up from the 20s to here for 3 years. You know, they've merged with Agrium. As opposed to, let's pick a stock that we got our snot kicked in. That's a volatile stock. You know, it's double bottoming right now. Theoretically, we should be buying it. But I have enough oil. And if there's no conflict in Iran, maybe it takes 2-3 years for this to come back. I can do things with my money in the meantime. So let's just finish up with what to do with oil calls. So we've gotten rid of a lot of our oil stocks in the fund. And if there's a disruption in the oil market, that means that our calls probably all go back to the positive side very quickly. Not by much. I mean, we have a lot of ground to make up. But if we get back to evenish or a little bit up on the calls, you take all that profit, and I think you're done. I think you're done with oil until late next year. And late next year, if we get the end of 2018 all over again, and if there's a Democrat in the White House coming, then we can start talking about oil again for one more trade. Because the scenario on oil is this. If there's a supply disruption, prices go up, we make some of our money back on this set of investments. If there's no disruption in oil, oil probably is weak for another year or two. But if the Democrats get the presidency, by executive order, the president can change a lot of things. And those things would include much tougher regulations on oil, probably no more oil off in the ocean, and probably no more oil drilling on public lands. So they'd contract, they take away all the things that Trump did. And that would bring us back to, a rising oil price situation. And the Democrats are motivated for that to happen because the higher the oil and gas price, the more likely it is we switch to alternative energy faster. And with the cost curves for alternative energy coming down, right, then that moves very quickly, which is why we need to be in here, right? Energy storage. About a year ago, I talked about zinc air batteries, and somebody pointed out an article this week. I do my research. I'm usually a year ahead of the public. I'm usually 3 to 6 months ahead of other analysts. So energy storage is a big deal. We're going to find more investments in that. All right. Which companies will be affected by new tariffs? A lot of them, right? Anything in technology. Apple will be affected. I mean, we might get an opportunity to buy Apple cheap. Apple is down a little bit today with everything else. But man, if we can get Apple around 170, I'm a buyer. If it goes down to 150 again, I'm backing up the truck. I'm going to make a statement, and this will probably be an article title. If you like bank stocks, for whatever reason, but if you like bank stocks, you should love Apple and Google. Because Apple and Google have more money than the banks. They can lend and invest better than the banks. and they have way more growth than the banks. There is virtually no reason to own banks. They are high risk, extremely high risk in this environment. They get beat up during recessions. They need bailouts because they're not managed well. Let's face the fact. The bank system is not managed well. We can praise Jamie Dimon for all the stupid things that he says, but I'm telling you, the banks are not managed well. They fall apart all the time. They're in a bad position now because the derivatives have built up again. If there's a recession, you're going to see all the banks get creamed. You're going to see Citigroup get creamed. I mean, I know that people don't even remember this anymore. Citigroup was $25 a share not too long ago. It was lower during the financial crisis. I don't know why I can't go further out. Oh, they only do so much on the technical side. Okay. Look at that. Bank of America. Oh, let's do it this way. Bank of America. Look at that. Crash. If you're just looking at this end of the chart, you're like, oh, banks are a great investment. Bullshit. Most of these banks will retrace at least 50% of this gain from here to here. So Bank of America was down at $4 a share. Now it's 29. So it's a $25 gain. To see these guys drop down into the teens, no sweat at all, right? In fact, this level right here, right there. I will go out on a limb and I'll say you will see Bank of America under 20 in the next 2 years. Do you like that bank now? Wells Fargo. Even Warren Buffett's backed off on this one, right? They survived pretty good and they've risen, but why can't they come all the way back down to here? Why can't they go down to like 35 again? Hint, they're probably going to. JP Morgan, right? Helped end the world. And then the bailouts, off to the races with the bailouts. Why can't JP Morgan go back down to around 50? I won't say that it will. I'm just saying that it can. Take a look at this chart. Nothing to do with bailouts. That's just organic growth. They're running into some growth problems on devices right now, but they're adding services. They still have a very high single-digit growth rate. The banks don't. So given that this one has generally gone up without a bailout, it has organic growth and has more money than the banks and has more control over its money than the banks, why wouldn't you buy Apple on the pullback versus a bank? What about Google? Come on, MeetNet. Let's move at the speed of Google. Let's go. Google. Right? Just goes up. Guess we should have used the other one. There we go. Just goes up. Buy Google on pullbacks. It's a little slower growth than it used to be, but again, more money than the banks, more control of the banks, less debt than the banks, more control of their money, higher growth, organic growth. And baby Googles. There will be baby Googles. They're pregnant with baby Googles right now. And while it doesn't pay a dividend, Your dividend is going to be the spin-offs in new companies over the next 10 years. And there will be at least 3 or 4, and I think there's going to be 7, 8, or 9. This is going to be what AT&T was many, many years ago. When AT&T spun off all those companies, these guys are going to do the same thing. They're going to spin off a boatload of companies. It's why they changed the name to Alphabet, because it's a holding company right now. Everybody thinks of it as Google, but it's a holding company of a lot of really good companies that are all on the verge of going profitable. So, in any case, that's what I got today. Heading off to the Wisconsin State Fair in about 4.5 hours. Racing pigs, cream puffs, various meats on a stick, generally with cheese and breading. What else do we got going on? Some big slides, some bands that I don't like, and some bands that were around when I was in the 80s. So I'll probably get to go watch some 70-year-old rockers. Should be a good time. In any case, have a great weekend. Diet's actually been pretty good. Today will be a cheat day, though. Have a good one. If anybody wants to meet up with me when I'm out east, I will put my itinerary on the site. And the day that, if you're like in the Connecticut area, let's see which day this is. The 20th, I will be in Westbury. So I'm doing a day trip from the Groton and Mystic area out to Westbury to meet a client. So if anybody wants to meet up in Westbury, on the 18th and 19th, I might be playing in the World Series of Poker. So I'm not positive that I'd be available. I am playing on the 18th. If I do well on the 18th, I'm playing on the 19th. But the 20th near Westbury, Connecticut. Cleveland, if you want to meet up in Cleveland, the evening, late evening, it'd be like 8 o'clock at night, Tuesday the 13th, or breakfast on the 14th is probably the better time. So Cleveland on the 14th for breakfast, Westbury lunch or happy hour. And then on the way back, here and here, I can stop along the way, probably in Pennsylvania, New York, and Ohio, Indiana. So these would be days that we can do that. So if you're along the route that I lay out, let me know. Have a good one.